Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and I'm joined today by Dyall, Head of Estate Planning for Tilney. Hello Ian.
Hi there.
So we're going back to basics with estate planning and tax-efficient investing this week. What are the basics of reducing your tax bill and estate planning?
Well, I suppose the driving principle with estate planning is to try to balance the access that the clients are going to need with their own assets in order to pay for care, maintain a standard of living, whilst at the same time saving tax. And as a general rule, you're trying to find that optimum balance between tax saving on the one hand versus access on the other hand.
And say I have put a pot aside to pay for perhaps any long-term care I may need to sustain that standard of living that I have got used to, and I have some extra money that I'd like to be tax efficient with. What's the first step?
That's where it gets more complicated because there's a huge array of options available. But actually, I would say that if you distill it all down, there's really only three things you can do about saving tax. The first is to make best use of your allowances and your reliefs, the big ones there being the nil rate band and the residence nil rate band, and often that's done via the wills. The second thing is to reduce the size of the estate, and that could be spending more money if you're holding back artificially, or it could be giving money away, and that's where trusts can often come in as well to protect that money. And then the third area really is to cover what remaining liability there is using life cover, because that's a much more efficient way of paying the liability, and it gets around a bit of a cash flow issue on death where tax has to be paid before probate can be granted, before assets can be released, etc.
And you mentioned reducing your estate there. Presumably that's to do with gifting and looking after generations that are to come. Yeah,
I would say one of the simplest methods of saving inheritance tax is to give away, but just to make an outright gift of money to your beneficiaries. The difficulty with that is A, knowing how much you can afford to gift, and B, many people are uncomfortable about releasing the control of that money, maybe for just psychological reasons. They're just worried about affordability, but it could also be that they're worried about their beneficiaries getting divorced or becoming bankrupt, or maybe they're just not good with money. So that's where trusts can come in, because it allows you to give away assets but retain some form of control over those assets.
And what are the restrictions towards gifting money? There is a 7-year rule, isn't there?
Yeah, generally if you make a gift, you need to live for 7 years after making that gift for it to fall outside of your estate. There are certain small exemptions, £3,000 a year you can give to anyone, for example. And if you've got excess income, that's quite a useful one. So more income than you can actually spend, then provided you make regular gifts, so it can't be a one-off gift, so annually or more frequently, and it doesn't affect your standard of living, that too is exempt. So if you have got more income than you need, rather than let it build up in your estate, you're able to give that away as well.
And you mentioned trusts. How easy is it to set up a trust, and are there any restrictions around that? Because I imagine some people would be tempted to retain complete control over a trust, but then that isn't really a gift, is it?
No, you've got to be careful. If you retain too much control over a trust, then it can be seen as a sham. But trusts can be fairly simple to set up. Many life companies have off-the-shelf trusts available to use with their products. And most solicitors, if you're setting up a straightforward discretionary trust, that's a fairly simple trust to set up. And then in terms of running the trust from that point onwards, it's as easy or as complicated as you want to make it. If you hold simple assets in the trust, it can be fairly simple and cheap. If you want to hold a property portfolio which needs maintaining and rent collecting, etc., that becomes much more complicated from an administrative and a tax perspective.
Now, we've got a new tax year starting in a couple of weeks. We had the budget this week, but they didn't have too many surprises. But there are some changes coming in April, aren't there?
Yeah, and probably the biggest one in terms of inheritance tax is the residence nil rate band. So if you cast your mind back, the government was promising £1 million nil rate band at one point in time. That's slowly been watered down, frankly, to what we have now, which is on the surface £1 million between a couple. The way that's made up of is that in 2021 you will have your personal nil rate band of £325,000 for husband, £325,000 for wife. That's £650,000 in total. And then you'll have an additional nil rate band, which starts this April at £100,000 each, but will climb to £175,000. And if you add 2 lots of 175, 2 lots of 325, you magically come up with this £1 million figure. The thing that people need to be careful of, though, is it's not as generous as it sounds. Is that there are rules around it. So you can only use it against the residents that is part of your estate on death. That's can't be a rental property. It's got to be somewhere where you've lived. Yeah, correct. And secondly, it has to be what they call closely inherited, which means you've got to leave it to a child, grandchild, stepchild.
Immediate family.
Exactly. It can't be nephews and nieces. So that's the one that people need to watch out for. And it's also means tested. So if your total estate is worth more than £2 million, then for every £2 you're over that figure, you lose £1 of the residence nil rate band allowance. So, for many people, they need to be careful that of assuming that they're going to get that when actually in many cases they won't.
Ian, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.